Thank you for joining this webinar on the private investor ecosystem, incentives, capabilities, and behaviors. Some people believe the capital markets are a homogeneous group of investors, writing checks, investing in companies, all with similar goals and abilities. And that really couldn't be further from the truth. There's a menagerie of different investors, all of them with different incentives, different capabilities, and different behaviors. So it's smart for an entrepreneur or even a co-investor to understand how those incentives and capabilities are driving those behaviors. And that's what we're going to talk about today. First, a couple of notes on my background. I've been spending more than 20 years working in private investing, especially in emerging technologies. I co-founded and co-managed an early stage venture firm. I've invested money into venture capital firms for a large multifamily office and managed a single family office. And today I work with all sorts of private investors, from family offices to permanent capital vehicles, on their investing. At the foundation, I work with the Partners Program, which aims to facilitate awareness and partnerships between focused ultrasound companies and investors of every type. So why is this important? Why should we try to understand the investor ecosystem? Well, first off, to say the least, these relationships can last years or even decades. With private companies, you only stop being an investor when the company exits, and that can take a long time in some cases. Also, incentives drive behaviors, and different investors have different incentives. Different investors also have different capabilities. And so that combination of different incentives and different capabilities can drive really different behaviors, especially at critical points in a company's life cycle. So I'm going to propose a thought experiment. We're going to come back to it at the end of the presentation. But here's the idea. There's a hypothetical company. It's called MedDevices, and the board is excited to consider a $100 million acquisition from a large public company. That company actually has made a strategic investment in the company already. So they are investors. And so here's the current cap table. It's a list of the shareholders, the stakeholders in this company. It includes the founders, it includes the employees, and it includes three different kinds of investors in this case: a family office, a venture firm, and a strategic investor, which is the company that has just made this, this offer for acquisition. So we'll come back to this a little later, and hopefully with a little bit better understanding of how to think about how each stakeholder is likely to view this acquisition offer. Well, let's talk first about traditional venture investors. These are the folks that everybody thinks of when they think about investing in emerging, exciting new companies. There are many, many different types of these, but they all share a lot of common things. So while they have different investments based on stage or domain or geography, in this case, here's an illustration of the different stages of a venture investment, from early to growth to later stage, sometimes even crossover between private and public. They actually share more in common than they have difference. And these commonalities include both structures and incentives. So the graphic on the right is a schematic diagram of a typical venture capital fund or private equity fund. The blue pool is the pool of money from which they invest into companies. There are limited partners who are typically institutions who will entrust their capital to the general partner, that's the orange oval, to manage this pool of money and invest it into companies. And this partnership structure you see here is incredibly common. In fact, you would be hard-pressed to find any venture firms or private equity firms that are not structured very similarly to this. They also share common incentives, principally management fees and carried interest. Management fees are usually a percentage of the size of the fund, and that's for operating expenses. And the carried interest is a profits interest. It's a share of profits, if any, are generated by the fund. And that goes to the general partner to make its interest aligned with the limited partners. So they win if the limited partners win. And so these structures, these incentives, you will find in nearly every venture capital or private equity fund on the planet. And that makes their behaviors very similar. And so we can think of them as one group, the traditional venture investors. Those behaviors include a focus on generating returns and doing so across the entire portfolio. And this is a huge difference if you are running a company or you're a one-off investor, your venture investor brethren are thinking about how to generate the return from the whole portfolio. And to do that, they have to allocate capital pretty carefully across the portfolio as it matures. They're going to see which companies are doing better, which companies aren't doing so well. And it won't be any surprise to anyone to see that they're going to put more capital into the companies that they believe are doing better and are going to produce those good returns. They also want to add value, or at least look like they're adding value to each investment. And that has two purposes. One is it helps them differentiate to exciting companies where they'd like to invest. Sometimes it's competitive, and they need to distinguish themselves. And also to the investors who give them money to invest. And so they need to look like they're adding value to that process. And so these behaviors are all pretty typical of traditional investors. However, non-traditional investors are pervasive and increasingly active. On this graph, we see that CVC investors, that's corporate venture capital investors, have been in more than 25% of the deals recently. And that number has hovered between 20 and 25% for several years now. A different type of investor, the private equity investor, this could be buyout funds or growth funds, active in more than 14% of the deals. And a third type, asset managers, which could refer to mutual funds or ETFs, folks who normally don't get themselves involved in private investing, almost 10% of the deals. So collectively, it's a very active group that are seen in many, many deals. And that's why we need to pay attention to who they are. So there are many types. And I'm going to walk through each of these, not in a lot of detail, but at least conceptually, so we get a good sense of who they might be. I think it's useful to group them into some groups. This first group includes high net worth individuals, family offices, and multifamily offices. And they're really all basically rich people. Rich people who don't have, call it $100 million or more, probably won't create a family office. But if you did, it can be worth it to hire a dedicated team to manage your life, including your investing. If you're merely a high net worth individual, you might do all this work on your own. And so if you're dealing with a high net worth individual as an investor in your company, it's very likely you'll be dealing directly with the principal. Whereas if you're working with a family office, you may be dealing with a hired professional. Multifamily offices are for families who either don't want to or can't justify the expense of hiring a dedicated team. And so multifamily offices share teams of professionals across many, many families. That could be a couple of families, or it could be hundreds of families, and they can be sometimes very large. I've seen some as big as $100 billion. The next group, private equity funds, hedge funds, mutual funds, are really groups of professional money managers, again, typically in that GP LP structure we saw before, but who usually focus on public equity. In different ways. I won't explain all of those different ways, but suffice it to say that they come into the private investment world enough that we should pay attention to them, and we should understand the differences in how they see the world versus how other investors do. Another group are endowments and foundations, and they are typically serving, much like the Focused Ultrasound Foundation, a greater good. And so the endowments and foundations pools of capital need to be able to produce some revenue for the organization they serve to survive and thrive. And so they are investing often for the long term, but they have very particular constraints over what they can do in terms of risk tolerance and what the use of those proceeds will be. Sometimes if endowments and foundations are under about $1 billion or less, they might employ an outsourced chief investment officer. Similar to a multifamily office, these outsourced chief investment officers are teams of investment professionals that do all the investing for the foundation or for the endowment. Another group are public and private pension funds. These can be very, very large, teachers' retirement, firefighters' retirement, police retirement, et cetera, or for companies themselves. And they too often invest through funds, but sometimes will co-invest with those funds. And so you'll see them investing directly in companies. We've talked briefly about corporations. That's in our thought experiment. These are very different, and it's important noting that they are focused principally on generating strategic value for the corporation. It's likely they're going to want to create financial returns, but they are mostly going to be measured on their ability to create competitive advantage for the company. So it's a very different motivation than many of the other investors on this page. And lastly, and sort of the largest of the bunch and the least common, are sovereign wealth funds. These are literally the money of nation states. They haven't really been active on the scene until recently. Several of them were investors in SoftBank's notorious and very large $100 billion vision fund. And so they too will occasionally invest either through funds or directly in companies, and it's worth knowing who they are. Each of these types have different attributes. Their incentives differ. Some are focused on return generation, as we discussed. Some are focused on strategic value generation. Those are the corporations principally. Some have a profits interest. They share in the upside. Some do not. Some are putting their own capital at risk. Some are not. Some are putting their careers at risk when they make a decision. Some are not. They have different capabilities, including how big the pool of capital is that they can put to work, including the types and speed of their decision making, and including how flexible they can be as assumptions change and as the world changes. All of these incentives and capability differences lead to different behaviors, including risk tolerance. Are they risk seeking? Are they risk avoidant? Again, how quickly can they make decisions? Whether they're willing and able to take board seats or observer seats, whether they are willing and able to guide management, to help the company directly. Some might have a lot of expertise to offer, some none. Some are purely financial investors. Others are really trying to make the company succeed because they either like it, it's fun, or they have to. Are they willing and able to protect the interest of all stakeholders? If you take a board seat, you have a fiduciary obligation to do so. If you don't, you don't. How thoughtful are they about reserving for follow-on investments? How long can they or do they want to hold an investment? And finally, how do they look at exits? And this will be directly informative of our little example. So here are a few dimensions across which we can look at the differences of these different investor types, and particularly in terms of these behaviors. One dimension is principal versus agent. Are we dealing with the principal or are we dealing with an agent for the principal? And is that principal or agent putting their career on the line when they make an investment decision? You can see here that in vast majority of cases, the financial investors are indeed agents, and they are putting their career on the line. Whereas if you're dealing with a high net worth individual, you're dealing with a principal, and they are often not putting their career on the line, though it's entirely possible they could damage their relationship with their spouse if they make an unwise investment. Are they sharing in the upside? You'll see a wide variety across these differences, from single family offices up through multifamily offices. In some cases, the answer is absolutely yes. For a venture capital firm, that's part of the deal. In some cases, absolutely not. Another dimension to consider are whether or not financial returns are required. If so, what the magnitudes are. And if not, what are these non-financial returns and expectations? Again, we see a lot of variety. Family offices often invest for non-financial reasons. They might be trying to give the next generation something interesting to work on. They might be trying to leverage deal flow and domain expertise that they have from the business that made them their money. Whereas venture capitalists are purely financial animals looking only to make a financial return. And oh, by the way, trying to make one that is very, very powerful, because their venture funds often have a very high attrition rate. They lose a lot of companies. So they have to have the ones that perform really well. So we see a high degree of variability between the return expectations of each of these categories. We also note that there are differences in the hold period. How long is too long? Sometimes they have no control over this, sometimes they do. And whether they're measuring your company's performance against a portfolio of other companies or not. Different investors also have different capabilities, and it's worth looking at some of these dimensions here. capital reserves. For venture capital, there's a sort of systematic way to go about predicting how much capital a company will need until exit and planning for that. This can be done by these other investors, but sometimes it's not. And so sometimes later rounds can take those investors by surprise. Again, we've talked about, whether you're dealing with a principal or an agent, it's also important to understand if you're dealing with somebody who can make the decision themselves, even if they are an agent, or whether they have to go through a bureaucracy, which might be quite significant. And this is often the case with corporations or endowments, pension funds, sovereign wealth funds. And so one needs to be mindful of that. Another really important dimension is whether this investor is going to be with you for the long haul. All of these are deep-pocketed professional investors, but some are more risky than others. Corporate venture capital units notoriously will come and go as new CEOs come. They go in and out of fashion. And so the whole unit might be disbanded in the middle of an investment, and that's not good for you as the company. But it's important to think about what's the life cycle of each of these investors as you consider inviting them into your cap table. And then finally, varying degrees of ability to assist the company, even if they want to. Varying degrees of ability to think or act creatively. And this is so important these days as assumptions change and environments change overnight. Okay, so back to our thought experiment. Recall that MedDevices has a $100 million acquisition offer from a large company. It's a company that had previously made an investment in MedDevices. The company's raised in total about $35 million. And so how do we think each of these stakeholders might react to this offer? So I'll remind you again, we have here my laser pointer. We have several types of shareholder or stakeholder, the founders of the company and the employees they have hired since they founded the company. They typically are going to hold common shares. These have lesser rights and privileges than preferred shares. And so it's important to understand the dynamics between the preferred and common holders. The preferred holders are made up of the three investors we talked about: a family office, a venture firm, and the strategic investor, which is also the same company that is making this offer. And we'll note here that the company, the strategic investor, owns just south of 20% of this company. That's probably not an accident. Oftentimes, corporate investors will have to aggregate financials, consolidate financials, so they try to hold less than 20%. But at any rate, they already have a considerable holding in this company. So to get a better view of the dynamics here, let's look at the cap table. This is basically a history of the investing in this company. And we'll see that there have been three events: a seed investment, a Series A investment, and a Series B so far. The seed investment was done by the family office, and it appears here they put $2.5 million in. They were the only investor, so that was the total amount in. And they did so at a pre-money valuation of $5 million, which basically means that they said, hey, company, you're worth $5 million before we put in our 2.5. And so after we put our money in, the company is worth 7.5, 5 plus 2.5. So that's the first investment event, the seed investment. In the Series A, we see that a venture firm came in and they put $5 million in. We see also that our family office put $1.5 million. So that's an additional $1.5 million. But this was done at a very different pre-money valuation. This was $20 million, so significantly higher value than even the post-money of the last one. That means on a per share basis, the new investors and the incumbent family office for their money are buying less shares proportionally. So now we have a total of 6.5 from a Series A, 2.5 from a seed. And then third and the last round so far is a Series B. We see that the family office put a little bit more money in. The venture firm doubled down, and the strategic investor came in for $20 million. But again, we noticed that this company, because it's succeeding, was able to raise money at a pre-money, very high pre-money of 75, or relatively high compared to its last round. And this meant that for its money, the strategic only bought 20%, whereas we note back here for $2.5 million, the family office bought almost half the company. So this is a sort of, sedimentary history of the financing of this company to date, 35 million in, but at very different amounts and valuations. And that means that the outcomes will be different for each of these investors. So as we wrap up, let's look at these outcomes and try to guess at what the posture may be for each of these stakeholders. Let's look at the management team first. $28 million of 100 to the management team. I don't know here if this management team is 100 people or 1,000 people. So depending on how big it is and who owns what, this number may be life-changing or not. It's hard to say, but it's always important to know and look carefully at how the management team will fare in an acquisition. But since we're looking at the investor ecosystem, let's examine case by case each of the outcomes here. The family office, which put in 2.5, followed by 1.5, followed by 1, for a total of for a total of $2.5 million, is going to make nearly 6.5 times its money, $31 million for their trouble, which is a 31% IRR taking into account time. That's pretty great. Hard to argue with that. The venture firm, on the other hand, put in 5 and 5 and is going to get nearly $19 million for almost 2 times its money. That also seems pretty great. Well, hold on a second. It seems pretty great until you consider that a venture firm usually loses 70 to 80% of its portfolio companies. That means the remaining portfolio companies often have to produce powerful returns, 10 to 100 times their invested value, in order to make up for the losses. So for a venture firm, this 1.9 might be a terrible outcome. But we don't know the venture firm's current situation with their portfolio or what they think about MedDevices. So they might also say, well, there's no such thing as a bad profit. We'll take our 2 times our money and go home happy. The strategic investor, very interestingly, has put in $20 million and will get only 19.6. So they've technically lost money. So why would they do that? Well, they might do it if they're the if they've made the acquisition offer, which in this case they have. So they're really only buying the remaining 80% of the company because they've already bought 20% of the company at a lower price. So on a blended basis, they've made themselves a pretty good deal. And so if they are the acquirer, this looks like a pretty good idea. If they're not the acquirer, this looks like a bad idea. And so what we see here between the different stakeholders, management, and the 3 different types of investors, potentially very different postures or reactions to this offer based on when they came in, at what value they came in, and how much they invested, and what their incentives and constraints are as investor types. So, takeaways. Relationships can be long-lasting in private investing, years or even decades. Incentives drive behaviors. Different investors have very different incentives. They also have very different capabilities. And as such, as investors or as management, we should expect different behaviors, especially at crucial points in the life cycles of a company. Thank you very much.